You didn't come here to hear promises. You came to understand how real money is entering the crypto market. Your click on an ETF doesn't just stay with the broker, it ends up as a real purchase in the spot market. Today, we're going to walk you through that process step by step, using simple language so that every price movement has a practical explanation. During the video, you'll see some brief terms on screen, and at the end, I've included a simple glossary in the description for you to have on hand when you need it. The ETF gives you a price and regulatory simplicity. Buying directly gives you on-chain access and key control. And most importantly, verify your country, your broker, and the specific product before buying. In the description, I've included the glossary and checklist for you to review carefully. Let's return to the engine that drives price. Big movements don't come from noise, they come from portfolio policies. There are 3 layers of flow that push the price without making a fuss. One is regular contributions. Every month, payrolls feed retirement. Let's start from the beginning. This content is educational and is not financial advice. Do your own research and be aware of the risks. Let's start from the beginning. Traditional money and decentralized money no longer exist in separate worlds. ETFs have become the regulated gateway that the financial system understands. They allow banks, funds, and retirement plans to gain exposure to Bitcoin and Ethereum without opening a wallet or handling keys. For a pension fund, that means convenience and control. There's a ticker, reporting, auditing, custody, risk controls, and known tax implications. And although the S&P 500 lists companies and not assets, it already includes a crypto-native company like Coinbase and coexists with adjacent crypto companies in payments, semiconductors, cloud, and custody services. It's not Bitcoin itself within the index. It's indirect exposure that, when added up, feeds the ecosystem and gives it depth. Think of 2 worlds approaching each other via a bridge. On one side, the world of investment committees, rules, and reports. On the other, the world of blockchains, keys, and 24/7 liquidity. The ETF is the bridge. It speaks the language of both. It provides governance for fund managers and flows for the crypto market. And when a bridge is safe and easy to cross, more people cross it. Now let's calmly define what a spot ETF is in plain language. A spot ETF is a fund that attempts to track the price of the underlying asset by buying it on the spot market. The value per share is called NAV. It's the value of the fund's actual inventory divided by the number of shares. To keep the ETF's price from deviating from its NAV, there are creation and redemption processes. If there's high demand, the fund creates new shares. If there are outflows, it redeems existing shares. In crypto, this is almost always done with cash. Money flows into the fund, and the custodian executes spot purchases until the inventory is aligned with its required holdings. A straightforward translation. Your ETF purchase is ultimately converted through the custodian into actual orders for Bitcoin or Ethereum. Not always in the same second, but always within the mechanism that keeps the ETF linked to its underlying asset. That's the first key idea. The ETF isn't just an empty piece of paper, it's a gateway that directs the flow of funds toward the underlying asset. Think of the market as a lung. When there's demand, the fund inhales, creates shares, cash flows in, and the custodian buys spot. When there are outflows, the fund exhales, redeems shares, reduces its inventory, and liquidates on the spot market if necessary. This keeps the fund's price close to its NAV and simultaneously provides the market with a dynamic rhythm. Before we continue, let's talk for a minute for those who are starting from scratch and have never invested with a broker. Imagine opening an account as opening a digital bank account, but for investments. First, choose a broker regulated in your country or region. They will ask for your information, verify your identity, and allow you to fund the account by a bank transfer or another available method. Second, in the broker search bar, enter the ticker symbol of the fund you're interested in. A ticker symbol is a short code, like a license plate. Third, choose how much to buy. You can enter a specific amount of money or a number of shares. Confirm the order, and that's it. Fourth, you'll see the position in your account just like a stock. You don't receive Bitcoin or Ether in a wallet. You receive shares of the fund along with reports and account statements. Fifth, if you want to sell later, log into your brokerage account/portfolio, select the position, and place the sell order. The money is returned to your brokerage balance. That's the basic, simple experience with controls and the same logic as any ETF. If this part sounds new, don't worry. From here on, everything will be clearer because you'll already know how the process works. How do you invest in a simple cryptocurrency ETF through a broker? If you've never bought through a broker, the basic experience is like this. You open an account with a regulated broker in your country or region. They ask for your information, verify your identity, and you fund the account by transfer or another available method. In the search bar, you enter the ticker symbol of the fund you're interested in, the ETF short code, choose how much to buy, amount or number of shares, and confirm the order. From that moment on, you see the ETF in your portfolio just like a stock, with reports and account statements. If you want to sell later, you access your portfolio, choose the position, and place the sell order. The money is returned to your brokerage balance. Remember, an ETF gives you exposure to the asset's price. It doesn't provide keys or on-chain functionality. Helpful note, throughout the video, you'll see brief terms on screen, and I've included a simple glossary in the description for reference. For Latin America and Hispanics living in other countries, this isn't the same everywhere. It varies depending on regulations and the broker's access to the exchange where the ETF or ETP is listed. United States, you buy spot Bitcoin or Ethereum ETFs through your traditional broker. You don't even exchange account for the ETF. Common examples include Fidelity and Charles Schwab. Canada, there are local crypto ETFs and ETPs, and the most well-known Canadian brokers offer them to Canadian residents. A typical example is Questrade. Europe, Switzerland, Germany. There are physical ETFs and ETPs for Bitcoin and Ethereum listed on etc., SIX Zurich, and Euronext. Examples of brokers operating in several European countries include Saxo. Always check the exchange, commission, and the product brochure before buying. United Kingdom, some listed crypto products are restricted to retail investors. If you live in the UK, confirm with your broker whether you have retail access or if they are only for professional investors. For Latin Americans residing in Latin America, in several countries, you can buy foreign ETFs if your broker provides access to international markets. In others, access is limited or only local products are available. An alternative used by many outside the U.S/EU is Interactive Brokers. It operates in multiple countries. For Hispanics living in non-Hispanic countries, the regulations of your country of residence apply. If your local broker doesn't list the ETF/ETP you're looking for, ask if it allows you to trade on the exchange where it's listed and confirm taxes, currency, and required documentation. Keep this quick checklist in mind. My broker allows trading on the exchange where the ETF/ETP is listed. The product is permitted for retail investors in my country. I understand the ticker symbol, commission, and spreads. I understand the tax treatment and exchange rate risk. I want price exposure, ETFs, or I want on-chain use, exchange plus wallet. I need to open a Coinbase account to buy an ETF. No, you buy the ETF through your broker. The fund may use institutional custody behind the scenes, sometimes Coinbase custody or others, but you don't need a Coinbase account to own the ETF. You would use Coinbase or another exchange if you want to buy Bitcoin or Ethereum directly to use the network, move funds, pay DeFi, or perform self-custody. A product is not the same as an asset. T-plans and funds. Part of it goes to the core index fund, and another part goes to the core+satellite fund via ETFs. This repeated trickle across thousands of portfolios is a silent river that ends up in the spot market. 2. Rebalancing. Every month or quarter, portfolios return to their target weight. If Bitcoin rises too high, it's reduced. If it falls, it's repurchased. This isn't an opinion. It's a written rule that, when executed at scale, generates orders that don't make headlines but do move the price. 3. Creations and redemptions. When the ETF's price deviates from the NAV, Authorized participants create or redeem ETFs to realign it. This activates the custodian, and the custodian trades in the spot market. This is the result of adding up the 3 layers of actual orders in the spot market. Therefore, before believing a narrative, ask yourself, was there flow? If there were contributions, rebalancing, and creations, you're probably seeing the engine in action. A simple example, a fund with $10 billion allocates 1% to a Bitcoin ETF. That 1% represents $100 million in target exposure. If it rises significantly and rebalances, it sells a portion. If it falls, it buys a portion. The ETF adjusts its inventory, and the custodian executes on the spot. Millimeters in percentage terms, mountains in cash capital. Now, the S&P 500 and how the exposure seeps in. The S&P 500 lists companies, not Bitcoin. Even so, crypto exposure comes in through 3 routes. Route 1. Core portfolios with satellites. The core replicates the broad index, and around it, between 0.5% and 2% is added in Bitcoin or Ethereum ETFs with scheduled rebalancing. This allows access to crypto without changing the entire portfolio. Route 2. Crypto-adjacent companies, payments that earn commission when activity increases. Institutional custody that charges for safeguarding keys, chips for data centers and mining, cloud services that bill when Web3 projects scale. They don't buy Bitcoin on their balance sheet, but they benefit from the ecosystem. Route 3. Index tracking products plus satellites. The index doesn't change. The portfolio that replicates it can. Yes, a manager can add a spot ETF as a satellite while keeping their product linked to the index. Exposure to a company is not exposure to the underlying asset. A stock depends on revenue, margins, debt, and regulation. A spot ETF tries to track Bitcoin or Ethereum. Sometimes they move together, sometimes they don't. That's why it's important to distinguish the path you're taking to gain exposure. Same asset, 3 vehicles, 3 risk experiences. A spot ETF tracks the asset's price, doesn't give you the keys, but offers simplicity, auditability, and known taxation through your broker. Ideal if you want clear exposure with straightforward reports and institutional governance. A futures ETF provides exposure via contracts. It can accumulate differences compared to the spot price due to rollover costs. Useful for tactical trading, but not the same as the spot price. Direct purchase, full sovereignty, and on-chain use. You can move, pay, interact with DeFi, and, according to rules, stake on Ethereum. In return, you have full responsibility, the key, security, backups, and gas. It's not about which is best for everyone, but what you want to optimize. Simplicity and reporting, spot ETFs, on-chain use and control, direct purchase, tactical trading and hedging, derivatives only if you understand them. The golden rule is this: the vehicle determines your experience. The underlying asset defines the long-term direction if its thesis holds true. The vehicle defines the trajectory and the risk along the way. Let's talk about risks in plain English. Tracking is the difference between what the ETF does and what the underlying asset does. It's driven by fees, spreads, slippage, and creation and redemption times. A fund with good execution and an agile custodian tends to track better. One with slow processes will fall behind, even if the logo is famous. Premiums and discounts. Sometimes the ETF trades above the NAV, net asset value, and sometimes below. Creations and redemptions help close the gap, but in times of stress or low liquidity, it can widen. Buying at a premium means paying more than the value of the underlying asset. Selling at a discount means receiving less. Underlying liquidity is crucial. Not all liquidity is created equal. There are different times, depths, and locations with better prices. If the custodian executes market orders during off-peak hours, it gets worse execution. If it splits orders and uses aggregators, it improves execution. Custody and counterparty are also important. Who holds the fund's coins? Are they segregated? Is there an independent audit? Is there insurance? And how long does it cover? A good custodian reduces operational risk, while a poor one increases it. Regulatory frameworks, rule changes, Staking policies on Ethereum and network events like forks are also crucial. If the ETF doesn't allow staking, there's no on-chain return. If staking is eventually permitted, it must be documented how it affects tracking and risk. In short, choose your investment vehicle with your eyes open. Don't just look at the annual fee. Consider the custodian, execution, liquidity, and policies. For example, paying a 0.25% fee with sluggish execution can end up being more expensive than paying 0.35% with smart execution. The total cost is the fee plus spreads plus slippage. Choose mechanics, not slogan. Now let's return to the question everyone asks when they see the price moving without a major headline. Why did it go up today? Why did it fall if there was no news? The answer often lies in a system. Scheduled contributions that come in every month, end of quarter rebalancing that involves selling or repurchasing, and creations or redemptions that realign the ETF's price to its NAV. This set of rules translates portfolio decisions into real spot market orders without anyone having to manually place bets every day. That's why, when the market seems to be moving without explanation, look at the flow schedule and remember the mechanics. A couple of quick analogies to help clarify things. First, think of the ETF as an elevator. The floor it should be attached to is the NAV level. If it goes up or down too much, authorized participants step in and realign the elevator with the floor. To do this, they need to open the door to the spot market. And that opening and closing represents real buying and selling. Second, think of the institutional portfolio as a garden with automatic irrigation. A little water every day, pruning and balancing every month. It's not spectacular, but it keeps the garden healthy. In the market, that watering represents contributions, and that pruning represents rebalancing, and the result, on a large scale, moves prices without fanfare. What changes when the public understands this? They stop chasing headlines and start looking at the structure. How much comes in through contributions? When does rebalancing occur? How efficient are the creations and redemptions? And who holds the inventory? And when the conversation shifts from what a certain account said on social media to what the flow was this week, you go from reacting to the noise to interpreting the mechanics. To conclude, an idea that will always serve you well: the price follows the mechanical flow. Periodic contributions, rebalancing, and creations or redemptions. Less friction means more adoption and more spot orders. The question isn't just what Bitcoin or Ethereum is, but through which rail money flows into the spot market. When you understand the rail, you understand why sometimes the price rises without headlines and why sometimes it falls without drama. It's not magic, it's mechanics. If you take away one key phrase today, let it be this: a vehicle is not an asset. The asset may have a powerful thesis. The vehicle determines your experience and your risk. Learn to read rails, and the chart will cease to be a mystery. In the next video, you'll see a visual example without a tutorial showing two real-world ways to gain exposure to the same asset: an ETF with institutional custody and a direct purchase using the Coinbase ecosystem. Same asset, different risk experiences. If you found this helpful, subscribe and leave your ETF recommendation in the comments. I'm sharing the allocation template and a comparison table so you know what you're buying, which rail you're investing in, and what risks you're taking. Thanks for watching. We'll continue block by block, rail by rail. See you in the next video.